Do you mind giving us a quick introduction? Who are you and what are you doing?
Good afternoon, everyone. I am delighted to be here. This is pretty exciting stuff that's going on this weekend, and I'm honored to be a part of it. I am Pat Miller-Zoller. I'm a partner and managing director with Neuberger Berman in our alternatives business. The alternatives business is focused on mostly private equity, where we have about $50 billion of assets under management. I started the Emerging Managers Fund in 2007, which I think is the reason why I'm here. So that's been a very, very important part of our total business. So even though the assets are smaller, it's actually led to some really unbelievable relationships. We invest in managers when they are younger, meaning first or second institutional funds. The smaller funds, again, most of it is buyout. So again, funds under $750 million. And funds that have diversity in the leadership, diversity and lead representation from women or minorities. So the wonderful thing is that that product started in 2007. It's been one of the best performing products on our platform. And it's actually, thank you, excited. I think it proves what most of you in the audience know, that the two are not mutually exclusive, that having diversity and having great performance go hand in hand.
And I love it, Pat, when you say small, your firm has over $200 billion under management, so small is relative in your world.
It is,
yes?
it is relative, but as I was saying, the small piece is actually the types of managers that we're looking for in emerging managers, and those are funds that have that are under $750 million.
Okay, then we are micro. Okay. I'm Sean Escoffrey. I'm the program director for Strong Local Economies at the Servant Foundation. We're a 100-year-old family foundation with about $1 billion in assets, focused on creating just and sustainable communities across the U.S. We just recently launched a $100 million impact investing fund, so we're trying to move more of our endowment towards our mission, which is, again, to create just and sustainable communities. We do that through the arts and culture, through the environment, sort of a next generation infrastructure framework, and through strong local economies. So our impact fund is really focusing on funds that are focused on changing the world, sort of broadly. It could be anything from renewable energies or a sort of investment strategy that supports businesses with a low carbon footprint. Or an investment strategy that focuses on women and people of color entrepreneurs and growing their businesses with the hopes of creating good quality jobs in the process. Out of the $100 million, we have about $20 million that is dedicated towards program-related investing, where it's really aligned with our program goals. And one of the things that I've been doing in my program is looking at supporting early stage fund managers of color that are also investing in entrepreneurs of color, trying to also look at the ecosystem that's necessary to support fund managers of color to make sure that that they can really enter into the world of our full endowment and into sort of foundation investing in general.
Great, and I'm Kashif Sweet. I work at JP Morgan in the private equity group. Our private equity group sits within the asset management division. JP Morgan's a big place, but just to very narrow down our group, we have $25 billion in assets under management, 56 people globally, offices in New York, London, Hong Kong, and Beijing. We manage across the capital structure, assets across the capital structure. We invest in funds, secondaries, and direct investments with co-investments, and we lead growth equity rounds. I've been at the firm for 10 years. I've been with the group for 6 years, and we are really active in the emerging manager space. I'd say we've invested about $3 billion in emerging managers. The way that we define emerging managers is funds 1, 2, and 3, institutional funds. So if you had a friends and family funds, we won't really count that against you in your fundraising. And we are really active in finding funds 1, 2, and 3 across all different types of strategies, whether it's a leverage buyout, whether it's a venture capital strategy, whether it's an angel strategy. We're really opportunistic and bottoms-up investors. We don't have preset investment allocations. We really want to see anything and everything. We say no 95% of the time. As I've told people, please don't be discouraged, just keep coming back, because when we do invest, we tend to have a meaningful investment.
So also in their infinite wisdom, the organizers know that as a Latina who spent 2.5 years launching her company, her investment company last year, I was asked to be nice, so I will be.
Thank you.
Who said you have to be nice? I didn't.
Punchy, I was told to keep it punchy, but yeah, nice. Edgy? Edgy? All right. No. But I want to explore the term emerging managers a little more. And also just for the purposes of education, but also even to begin formulating the strategy for the people in the audience that are going to be approaching people like you. I was recruited by a big bank who loved a speech that I gave and loved the boxes that I check, only to then tell me that for them an emerging manager was a minimum of 100 million on my balance sheet. Not going to be there for a while. Even with a Buffett as an investor, there were a lot of things that were attractive. So who are their partners? What sort of investments am I making? I fit all of the qualifications, but the $100 million was a non-negotiable. So I imagine it's different for every organization. So can we explore with each of you, what do you define an emerging manager to be, and what do you look for in those first, second-time fund managers?
Maybe I'll kick it off, because we have a very political and broad definition on purpose, right? So we just define emerging managers as funds 1, 2, and 3, institutional funds. That's on the cover, but what we don't want to do is to get into someone who's had a fund 8 or 9, they spun out 3 people or carved out 3 people under the same firm, management company, and then put on a different name to that fund and then called it Fund 1, right? And we see that often, which is a great strategy, and kudos to being creative. But we want to make sure that you are your first time institutional investing fund or Fund 2 or Fund 3 coming to market. So that's a very broad definition, and I'm guessing there are more narrow definitions down the line.
So our definition is our client's definition. So the funds that we manage in the emerging manager space are almost always separate accounts. And we create separate accounts for our clients because each of them will have a different definition for what emerging managers are. And, there are some, we give guidance around where we think the opportunity is. So, for instance, we generally lean toward a first or second institutional fund, just because, we think that that's at the earliest stages. We think that, by looking at a second institutional fund, it means that if it was some kind of a hybrid where you had angel investing and other stuff in it, it'll still kind of fit the criteria. Diversity is something that, we found to be very important, and most of the definitions that we have are not just based on a definition per se, but it's based on the fact that we believe it'll bring value to the portfolio, because ultimately that's why our clients are hiring us. We believe, so first off, on the first or second institutional fund, we love the fact that we can back managers that are really hungry and that are really ready to, leave it all out on the court in order to be successful. We love aligning with managers who are putting a big part of their own wealth into the fund, meaning that, they really needed to succeed in order for themselves to succeed. We love the fact that first or second time managers know that if that first fund is not successful, there will not be a second fund. We love that alignment as well. So, we actually have thought about the attributes that we think kind of lead to a great alignment of interest, lead to value, the piece on the diversity front, and we've seen it in our portfolios. We've seen it over the 10 years plus that we've been doing this, is that it does matter when it's a woman or a minority that's trying to get that deal done, especially depending on who the other side of it is. I mean, it does matter having a different network than what some of the other more traditional PE firms might be. It does matter in terms of, kind of cultivating those relationships, around people that look different than what the traditional marketplace is. So we think that, the access to deals, the types of deals, the alignment of interest, all those things lead to value. So the definition is kind of which in that which of those factors, when you look at any given number of managers, will really lead to kind of the outsized returns. That's what we're looking for. Our clients tell us specifically, they may say, go up to a third institutional fund, or they may say, us manager is small, not at 750, but at $1 billion. But that ends up being kind of nuance, if you will. But what we're primarily looking to do is to back those managers, and our portfolios end up being primarily buyout. Again, because if you're trying to de-risk the portfolios, finding firms where the companies have already been de-risked a little bit because they are established, that also is kind of important to our clients. But ultimately what you're trying to do is to try to find those managers, try to find them early, back them early, so that when they are at their third or fourth fund and they're raising several $1 billion and they're oversubscribed, you can get your full allocation because you were there with them early.
Again, from the micro space,
We're going to start doing these questions in a different order next.
we're looking at, again, sort of first and second funds, usually the 10 to 20 to $30 million range. So these are really small funds. First-time fund manager, we're willing to take risk. We're philanthropy, so we're not necessarily looking for sort of crazy alpha or, these returns that, our return is that this fund manager succeeds and that they make a name for themselves within this field, and that the businesses that they're investing in succeed as well. And again, focused on women of color and people of color in general.
Whether it's a pet peeve of just something as, like, in your experience, that you don't like, or if it's an actual institutional screen, what are some of the things that are automatic disqualifiers, or they're red flags, or things that, especially for people in this audience, we want to know? An institutional investor is looking to avoid X, Y, Z.
Well, that's a good question. So we still have a very conservative sort of finance office at the foundation. So they are looking, even for a first-time fund manager, they're looking for their networks. They want to understand who they know, and they're asking lots of questions about, to make sure that they know the right people. This is something that we're trying to break down as well. So there's been a little bit of a disconnect. We still are prefacing the same schools and the same networks. And we're, my program, we're trying to say we actually have to take risks, and we can lose this money and it'd be okay. We're not going to discount, this fund manager just because they're a woman or just because they're a person of color. So we're trying to avoid the red flags, but we're trying to sort of lessen what the traditional red flags would be.
I would say, obviously there's certain attributes of a fund that will make it more likely to kind of get funding. Because, we're saying no most of the time. And so everyone that comes before us, the answer starts off no, and then you have to kind of get to a yes after you've answered all the questions. But I would say kind of more importantly, kind of what's something that, new funds, new venture capitalists should try to avoid is actually spending time with people that really aren't going to give them money. Quite honestly, I think sometimes people won't take, they think, well, again, if you're saying no, it's probably because you don't understand my product well enough, you don't understand what I'm doing well enough. But oftentimes it's because, there are just certain guidelines that they're kind of working under. And it doesn't mean you can't get to know the people, but time is really kind of precious. And when you're trying to raise a fund or you're trying to back a company, I think you just really have to be smart about where you spend your time, because there are lots and lots of groups out there that will back what you have. You just kind of have to find them. And you shouldn't waste your time with folks that aren't looking for what you're selling.
Yeah, I would agree with both of those, and to make sure I don't echo or reiterate what's already been said, I guess the only kind of pet peeve that we have is just to make sure that when you're coming in and doing your pitch, and this may seem like a no-brainer, but really lead with content, right? So come in on your game and lead with with the content that you're pitching. Oftentimes, we see people that come in that say, listen, we want to build this great firm, and we have aspirations to do this and aspirations to do that, but what is it are you actually going to do? Like, how do you really define it? How do you really map it out? Let's take it from a dream to a plan and then show us how you're going to execute that plan. And you don't have to have the fully attributed track record that everyone would love to have, or the seed investment into the firm to then build out the team, and the team already built out and global offices, but to really lead with, here is the plan, here's how I'm going to execute it, and here's the go forward, and here's what I need you for. And oftentimes, you'd be surprised that, sitting across a table from someone who's tried to get a meeting for 3 months, and they come in and they say, listen, well, here's what my vision and dream is, without really having that plan.
Pat, I wanted to be sure to ask you a question because you've talked about it a couple times here when you mentioned the buyouts, and especially in my case, as not a VC, as a later stage holdco, Berkshire Hathaway style platform, you said something during our prep session about the fact that there is more than just the world of VC, right? And there's public equities, there are multiple different sort of worlds that you wanted to be sure that we acknowledged and explored. Is there anything you want to say here about that?
Yeah, no, I think, the growth area, growth funds, which it sounds like what you're talking about in special situations, I think that those funds too are very interesting. I mean, I think, people that are, thinking about, some of the unique relationships or unique skills they have and trying to apply that in the portfolio context a little bit differently, especially when there's some evidence that that they are really good at that. I think that stands out. I mean, I think everyone now is kind of looking for, the strategy. They're looking to back the managers. They're looking to back the teams that are going to come at it, with something that's got some special sauce.
Okay, and then Sean, we talked about how even though you're working at a big bank, there are definitely ways to partner creatively. It's not just formulaic, and you're saying that in your thesis, right? You've kept it intentionally somewhat vague. You had some ideas about some creative ways that people could partner with big banks, even at the early stage.
Sure. And just a reminder, it's Kashif, but I think
Kashif.
what we try to creatively partner with, it's all good. If you weren't into the 80s R&B scene, it'd be hard to understand what Kashif really is.
Andrea said edgy.
Yeah.
She didn't say offensive.
Right. So be creative. Look, you're coming into a meeting, you've covered the landscape of institutional investors. Be creative, right? It's a grind, right? Starting out that fund, that firm, really, you may be trying to figure out what your CapEx is and where you can shift things from, or where you can really spend a lot of money on. And so be creative. That's the name of the game, and not just from the startup phase, but with institutional investors. So case in point, if you were trying to raise money from our group, who we invest about $3 billion a year, I mainly focus on direct and co-investments. Before it was mainly leveraged buyouts, and now it's leveraged buyouts and growth equity. And there are ways to structure deals so that the leverage can shift from just JP Morgan having the capital and then you really wanting the capital from JP Morgan to, look, JP Morgan really wants something that you have, right? And that's either the skill set that you brought, that's a deal that you may have that may be hot and timely and that we're really interested in. And you can use that to then leverage to get what you want, right? So we have put over 25 managers into business. And out of that 25 managers, I'd say about 9 or 10 of them came with a deal. We did not know them for more than a year or two. And with that deal, we were so interested in that we were able to structure an SPV or a blocker corp or whatever the case may be, to then say, look, we're going to invest in this company. We're going to pay you special fees and economics. And then we're also going to put a stake into your firm. So that's a creative way where you went out and you hit the pavement and you found a deal and we thought it was attractive. And this may have been the 12th deal that you showed us, but once that happened, you then said to us, hey, look, you want to get access to this deal, you need to invest in my fund, and then you could have a a logo that could potentially help with other fundraising. So there are creative ways in doing it, and I wouldn't restrict your creativity in trying to figure out how to work with large institutional investors.
Okay, so before I get real creative with the names, can we take some questions? What is consistent with what gets you to yes, and what are some of the common causes for no's? Anything that we haven't already said?
I mean, again, as I said, it does start off with no, and you've got to get to yes, right? Because it's so many, right? And you have a portfolio, you want to be selective, you want to create the best, you want to find the best ones. So it starts off, and there's not an unlimited amount of capital that you have to invest, right? So it starts there. So it starts with no and kind of what gets you to yes. So the first questions are, kind of who you are ultimately backing a team. You're backing individuals. Who are these people? What do they bring to the table? What are the opportunities they've already identified? If they're a first-time fund, what capital have they had in the past, and how have they invested it, and what kind of returns do that make? Who else are they bringing? Is this just like one person you're backing, or is it a team? I'd rather back a team than kind of one person. What are they going to do together? What about all those other things? I mean, is this someone where you're going to want to, have to bring in? I mean, they've found great opportunities, but you're going to have to bring in additional resources in order to, to really help them. Maybe you're going to help them on the compliance side. You're going to help them on the legal side. I mean, any number of the aspects and attributes that you could bring from your platform to help them be successful. But for as you go through, it ultimately gets down to kind of who are you backing where you think they're going to be able to get outsized returns, and those returns, all returns aren't equal, right? I mean, returns that take you, a really, really long time is probably not as great as those returns that you can see over, a more immediate term, just kind of based on the nature of the assets that I'm managing.
So I think this one's a quick one in terms of reiterating how opaque this space is, which is why it's so valuable that you're all here. How would you suggest that prospective fund managers find, qualify, and approach the right people at the right firms? As you said, not everybody's the right fit. And I think this is a timeline question. What should be the expectation from first meeting to commitment? Is this a 5-month process? Is this a 5-year process?
That's a great question, and I think whoever asked that question is laser focused on when the capital is going to be deployed, which I applaud, because a lot of people will come in with a fund or a deal and say, look, we're trying to close in 3 weeks. And I don't know how necessarily realistic that is for large institutional investors who have investment committees, who at times, we don't have this problem, but other institutional investors it's not a problem. We don't have this issue, but they may need to go to other LPs to get the approval, and that may take some time. Really understanding and asking off the bat, listen, what's your process and timeline, should be one of the key questions that a fund manager comes in and asks. And look, you're pitching yourself to them, but they're pitching yourself to you, and don't ever forget that. They should really set the stage for you, because you are the ones that bring the opportunities to the institutional investors, and they may have a silo in themselves, but they're in this business to meet people like you to find opportunities, and being able to match that up with their timing is really important. So make that be one of the first 3 questions. What's your timeline typically? Because it may be a non-starter if you have a deadline and their process can't get there.
Do you have a sense of what yours is? Does it depend?
Oh, yeah. So typically, we like to say that we can move quickly, just like everyone likes to say that they can move quickly, but let's just be realistic. We have an investment committee, which I'm a part of, that is around 22, 23 people, and we sit around the war room just like every private equity or venture capital operation does on a typical Monday or Thursday morning, and we discuss. And with 23 people around the table, we can sometimes not agree. And so that conversation can be iterative. Typically, it's about a 3 to 4 week period to get from initial idea / deal to telling the entrepreneur or fund manager we want to invest. The time period is much shorter if we don't want to. The courtesy that we can provide is early on saying, listen, this is not going to be for us. Please show us the next opportunity because we don't want to waste your time. Because time wasted for entrepreneurs and fund managers is the worst thing. So we can tell you no quickly, and if we're really interested, we'll let you know. And it's about a 3 to 4 week time period, and if you attach another 30 days, we have a ton of lawyers, we're a big shop, another 30 days to close with all legal documents.
I guess I would just add to that. Our timing, we take as much or as little time as we need. So, and oftentimes it depends. So if it's a fund and it's a first-time fund, a lot of what you're doing is over the course from the time you meet that individual at the beginning until you are even getting to a point where you might invest. A lot of it is kind of monitoring. A lot of it is kind of seeing what kind of milestones that manager will make across, over time. And I think it's important to know that when you come in and see someone, they're not necessarily, depending on what the if it's a deal, then someone will get started on it right away because the deal normally has some timeline. But if you're talking about investing in a fund where, there are first closes, second closes, and all along the way, what most institutions will do, unless there's something compelling that gets you started right away, they're going to wait, they're going to watch, they're going to monitor, they're going to get to know you, they're going to see if you start to find deals, they're going to see what those deals look like, they're going to see what your team is. So it's a process over sometimes a very, very long time because again, the answer starts off, at least for us, it starts off with no. I think it's important too, I would add kind of on that point, is that it's actually no different than when you are the venture capitalist and you're looking to back a company. You're gonna see lots and lots of companies, right? What are the ones you're gonna meet many, and when do you pull the trigger on any one of them? It's really after you've kind of iterated, it's really after you've gone through a long process of getting to know that management team, before you're ready to make an investment. So again, it's a little bit of the same.
Okay, so I'm going to merge a couple of questions here that are similar. I think I got 3 or 4 that are about the most important qualities that you look for in a first-time fund. I feel like we've covered that. I feel like I'm assuming that whatever you're mentioning here, you're mentioning it first because it's probably your top priority type thing. So we're going to move on to a couple that are about institutionals have a reputation for wanting to be first to be second or third or last. How do you get an institutional investor to be first? Are there any stories or characteristics of emerging managers where you were the initial lead investor?
Yeah, so for us, it again, there's got to be something compelling that makes us come in early, and normally that's in the shape of a deal, right? There's a deal that this particular group of investors wants to do, and they need you in because of some expertise you have. Mostly it's because of capital you have, and they're willing to kind of bring you into under the cloak and like let you see how they found this deal, let you see why they think it's interesting, let you see kind of the value that they're going to bring with the expectation that if you like it too, you could invest in it. So that's a way to get people in early because there's a timeline, there's something compelling, and there's a reason to come in early.
For us, it's the fund manager. So it's belief in the fund manager and what they're trying to build. In terms of the fund, we're willing to go in early so that you can leverage our name, a foundation in this space, that has significant assets. So we're willing to take a leap of faith based on the trust and the belief in the fund manager.
I agree.
Okay. Question that we're going to end with, and I think I can preface it by saying we all are working to improve these numbers, but do you have a percentage that you're starting with today in terms of a baseline of how many percentage of your fund managers are Black? I know, Sean, we talked about how you recently did an evaluation. It's better than the average, which isn't saying much, but it's still something.
I think it's about 7%, maybe, and we're talking about the full $1 billion. During the process of launching an impact fund and looking at mission-related investing, we did an audit of all of our funds and fund managers, and our board made a commitment to both ethnic and gender diversity in terms of fund managers. So with our CFO and our advisors, we're making every effort. Now we're actually asking the question. Before we weren't asking the question in terms of who's leading the fund and what type of representation in the entire firm there is in terms of gender and diversity.
In the vein of being accurate while also keeping my job, I will say that we can do more. Just going to leave it at that.
So
The
if you,
DNC vice chair just walked into the building as well. So in the vein
We
of
can
keeping
always do
all
more.
of our jobs.
We're out there in the market. We're opportunistic. We love. That's why I'm here. We can always do more.
Pat, similar?
So if you look at our emerging manager portfolios, the majority of those funds are African American. So we found that in the emerging manager space, and when we looked for, talented folks that were looking to raise their own fund, a great majority of them were African American, and that's actually paid off handsomely for us in the form of great returns. When you look across our portfolio, we've got just in fund investing, we've got about $23 billion. We've got another $8 billion or so in co-investments, all aggregating to about $50 billion. The one point that I would make is that as a percentage of the number of managers is probably, again, a smallish number, but in terms of a percentage of the capital, is actually really big. So for instance, if we look at a firm like Vista, run by Robert Smith, we actually first invested in Vista in my emerging manager fund. It's hard to believe that once Robert was an emerging manager, because he's obviously hugely successful now. But the reason why we create these strategies is because we do want to identify them when they're young and when they're early and grow right alongside them, do co-investments with them, provide debt for their companies, and then culminating in, we have a business that buys stakes in the management companies of private equity firms, a business called Dial. The first investment that we made when we started to make investments by stakes in the private equity firms was Vista. And again, based on that long-term relationship. So again, the numbers, total numbers of managers, certainly always one work to do. In terms of impact and importance to our platform, it's actually at the highest level.
Okay, so the last question is for you. By show of applause, was this useful?